Hello and welcome. In this video, we will continue our discussion on the long option straddle by looking at a couple of more examples using Citi Bank and Dow Chemical. You may remember from my last video, a long straddle is a trade that combines two options, a long call and a long put, both with the same strike price and time of expiration. The goal of a straddle is that the price of the underlying stock moves enough in one direction that the profit from one option exceeds the loss of the other option, resulting in a profit on the trade. Let's look at an example of a straddle one could place on Citi Bank and an example of a straddle one could place on Dow Chemical using options that expire in about 6 weeks. At the time of making this video, both stocks are close to the same price. The current price of Citi Bank is $49.42. A trader could place a straddle by buying both the $49.50 call option for $1.28 per share and the $49.50 put option for $1 per share for a total cost of $2.28 a share up front. This means that, for the trade to be profitable, the price of Citi has to either rise more than $2.28 over the $49.50 strike price, or the price of Citi has to drop more than $2.28 below the $49.50 strike price. In other words, for the trade to be profitable, the price of Citi has to either rise over $51.78 or drop below $47.22 before the options expire in about 6 weeks. If the price of Citi rises over $51.78, the profit on the trade is the current price of the stock of over $51.78 minus the $49.50 strike price minus the $2.28 cost of the options. If the price of Citi drops below $47.22, the profit on the trade is the $49.50 strike price minus the current price of the stock of less than $47.22 minus the $2.28 cost of the options. If the price of Citi does not rise over $51.78 or drop below $47.22, the trade loses money. Now looking at Dow Chemical, the current price of Dow Chemical is $49.91. A trader could place a straddle by buying both the $50 call option for $1.73 per share and a $50 put option for $1.28 per share, for a total cost of $3.01 per share up front. This means that, for the trade to be profitable, the price of Dow has to either rise more than $3.01 over the $50 strike price, or the price of Dow has to drop more than $3.01 below the $50 strike price. In other words, for the trade to be profitable, the price of Dow either has to rise over $53.01 or drop below $46.99 before the options expire in about 6 weeks. If the price of Dow rises over $53.01, the profit on the trade is the current price of the stock of over $53.01 minus the $50 strike price minus the $3.01 cost of the options. If the price of Dow drops below $46.99, the profit on the trade is the $50 strike price minus the current price of the stock of less than $46.99 minus the $3.01 cost of the options. However, if the price of Dow does not rise over $53.01 or drop below $46.99, the trade loses money. So that's looking at two more examples of the straddle on Citi Bank and Dow Chemical. I hope you enjoyed this video. Thanks for watching.